the great news for advisors is the opportunity is great. It's still going to be great. I don't see that changing in the near future. The competitiveness and the drive to recruit, the drive to bring advisors to your firm, it continues to change that the marketplace and what advisors can achieve. In 25 years, we've seen wirehouse deals going from, barely 100% of T12 to now upwards of 400% of T12. And that 400% might be a new number for people as they've not heard that, because 300% had largely been the headline number, but we're absolutely seeing deals at 400%. But what we're seeing is firms need to be profitable as they are looking at structuring these deals.
I just think there's a constant arms race in between broker dealers and RIAs out there in the industry right now. One industry leader will up the ante. The other firms are almost forced to follow suit, much like the custodians kind of race to zero, continuing to lower fees and lower ticket charges, kind of the opposite on the broker dealer side.
It seems like every single new deal, we're getting surprised by a new number that's beating the last one. The larger firms, when they lose an advisor and they have another one that comes in a similar profile, they don't want to lose two in a row. And so there's some gamesmanship that is happening within the deals as well. And again, with new entrants, it just creates more and more competitions. And there's a lot of times with an advisor that we think should be getting a top tier deal, and they come back with a second or third tier deal, and we end up scratching our head. We have to look at why that firm, and that if the firm is coming in with subpar economics and their value proposition is mediocre, then it's a pivot, right? We 86 that firm and move on to someone else.
Do you think we're at the peak of upfront economics? Hey, everyone. Thank you so much for joining the podcast today. As most people know, I'm sure through emails, publications, phone calls to your office, upfront deals for financial advisors to make a move from one firm to another right now are at an all-time high. And it's been a significant change. Almost on a monthly basis, we're hearing of firms consistently upping the ante to incentivize financial advisors to move to their firm. And while an upfront offer should never be the sole reason for a financial advisor to move firms or to choose one firm over another, it's a large part of the decision-making process. And we just wanted to discuss with you today what the environment actually looks like, why deals are so high, and where we expect it to go from here. And I decided to bring on the CEO of Bridgemark, Jeff Nash. Between us both, we've helped over 1,000 financial advisors make a move from one place to another, and we're constantly helping advisors in the environment. And Jeff, I really appreciate you coming on to talk about what you're seeing out there.
Appreciate it, Corey. Thanks for having me.
Yeah, absolutely. So, Jeff, as I mentioned, we're helping financial advisors get these types of offers all the time out there. What does the environment out there look like to you right now?
I've been doing this for 25 years now in some shape or form, initially working for companies, specifically LPL, and now working with Bridgemark and for Bridgemark and working for the advisors themselves for the last 11 years. And it's funny, it seems like every year we're saying the same thing. Deals have peaked, and yet every year they seem to go higher and higher. The competitiveness and the drive to recruit, the drive to bring advisors to your firm, it continues to change that the marketplace and what advisors can achieve. I think I think it's honestly going to continue, but what we're seeing is firms need to be profitable as they are looking at structuring these deals, right? And so there's a lot of, what I would call kind of footnotes in there or asterisks, and so, for example, in 25 years, we've seen wirehouse deals going from, barely 100% of T12 to now upwards of 400% of T12. And that 400% might be a new number for people as they've not heard that, because 300% had largely been the headline number, but we're absolutely seeing deals at 400%. But also the length of time on those deals had gone from 3 years to 10 years to now we're seeing some at 12 and even up to 15 years on deals. And so while the headline number is phenomenal, right, they're stretching it out to keep advisors around for profitability, knowing that they've got these advisors locked in, knowing that they've got the clients locked in, right, and they're going to get their profitability in some way, shape, or form. So really what we're seeing in the marketplace, and I'll let you kind of weigh in on it as well, because you're seeing a lot of this as well. At Bridgemark, we're going to move over 100 teams a year, and we're going to move them to as many as 25 different firms in any given year. And that number is going to change year in, year out as far as which firms win the business. So we have a really clear picture of what advisors are getting and what firms are offering as we're working with them really closely to understand the marketplace. And the numbers it seems like every single new deal, we're getting surprised by a new number that's beating the last one.
Yeah, I mean, I just think there's a constant arms race in between broker dealers and RIAs out there in the industry right now. One industry leader will up the ante, and the other firms are almost forced to follow suit. Much like the custodians kind of race to zero, continuing to lower fees and lower ticket charges until it's the race to zero. It's kind of the opposite on the broker dealer side, where different broker dealers, one will raise up to 100% of trailing 12 production, and some of the others have to follow suit to remain competitive.
Yeah, and they're increasing back end awards, and we're seeing new firms that historically was really staunch against giving, a smaller amount of money or even no money at all as we look at the RIA space. They're all coming to the table with now ways to give money. I've seen smaller RIA firms looking at financing options for themselves so they can give out money to advisors to win recruiting wars. We're seeing firms, the larger firms, when they lose an advisor and they have another one that comes in a similar profile, they don't want to lose two in a row, and so there's some gamesmanship that is happening within the deals as well. And again, with new entrants, it just creates more and more competition. The end game of some of this stuff is, where does it end, right? What we're in the middle of right now is what's going to be a pretty significant consolidation in the industry. And that consolidation, firms don't want to be left out, right? And so that's what they're trying to do, is capture advisors, capture as much market share as they can so that they're one of the surviving thrivers in the industry. And that's being driven by growth and recruiting. And if they're not growing, they are dying. It's an age-old expression for any industry. And it's really never been more true here.
Yeah, for sure. I mean, my next question was going to be, why are deals so high? What's driving these deals to go up? And I think we already covered there's just an immense amount of competition out there. And in order to stay relevant, multiple decades into the future, they need to have size and scale. They need to be winning the recruiting wars. There's also a lot of other things that help. Markets are at an all-time high right now. I mean, since 2009, we've been in one of the biggest bull markets ever. Obviously, that helps firms have a lot more cash to potentially deploy to attract financial advisors to their firms. Higher interest rates are extremely profitable for broker dealers. You're seeing a lot in the headlines right now about the spreads in cash sweeps, which is what firms are getting as an interest rate on their cash versus what they're deploying to the actual clients of those firms. Those spreads are pretty significant and it's pretty profitable. And as interest rates have been rising, that's something that is extremely beneficial from a broker dealer, from a profitability standpoint. So once again, much more cash to deploy. Jeff, did you want to talk about the emergence of private equity inside of the broker dealer space as well? I think that's just another huge driver.
Yeah, I mean, so what's happening in this industry is the profit margin, the historical growth rate, and the consolidation trend is driving enormous amount of outside investment, right? So to be really specific, profit margin. The broker dealers are making profit margin, but it's a growing margin, and the stock market continues to grow year in, year out. And if you look into the future for the next 10 years, while you may see down years, the expectation is the markets will be higher. And if the markets are higher, then assets grow. And if assets grow, then revenue grows. And so it's somewhat of a formulaic approach to this industry. Add to that consolidation of firms and advisors, right, with the retiring advisor base, and you have more profitability per advisor. And that's what's driving a lot of private equity investment into this industry. They see this as near term, right, 3 to 5 year window, which is what private equity typically looks at, as a 3 to 5 year window to just get their money in, grow the company, and get it out. And that investment in companies, in these broker dealers, in these RIAs, is exactly what they're looking at for the next 3 to 5 years. Realistically, I think it's going to be longer. I think it's a 10-year cycle that we're in the middle of. And what happens after that, no one has a crystal ball clearly, but I think we're in the middle of a 10-year growth cycle and consolidation cycle that we're going to see a lot of opportunity, right, for a lot of folks in this industry and a lot of money being kind of put into this industry that's going to drive valuations and drive recruiting deals. The interesting thing is you brought up cash sweeps, right? And so when we think about cash sweeps, it's one of those areas that is actually currently getting scrutiny. There have been some proposed class action lawsuits that people aren't getting enough money on cash sweeps. And that is one of the things, if we think about tailwinds versus headwinds, right? The tailwinds are what I just described with PE. The headwinds on cash sweeps is something that we might need to consider because that could be a headwind that may affect deals, right? As they are incredibly profitable, upwards of 50% of a firm's EBITDA, right? 50% or more of a broker dealer or RIA's profit could be tied, or custodian's profit could be tied back to cash sweeps, right? If that number shrinks, that's a huge hit on profitability. And that could be a real headwind on transition money, right? So while there are tons of tailwinds, there's always some headwinds out there as well that we're going to be looking out for.
Yeah, I mean, and it's not just the potential threat of lower interest rates. The Fed has mentioned a few times potentially lowering interest rates, but also, some of the lawsuits that are out there right now. Pretty much every large firm in the industry right now is in some sort of lawsuit to potentially, lower that spread like you were talking about. So it's kind of a multiple direction headwind, not just one.
Yeah, no question. And that's going to, right? So when we think about what happens to deals, right, while deals continue to go up and they continue to get higher, it's not always a straight line, right? There's individual fluctuations that can happen in there. I would even compare it back to like an Ibbotson chart, where over the long term of an Ibbotson chart, if you look at where it starts and you look at where it ends, clearly it's a significant higher. But as we all know in the Ibbotson charts, there are individual peaks and valleys in there. And I think that's what's happening with deals as well. And it can be firm by firm. It could be advisor by advisor, right? We always are working with advisors. And there's a lot of times with advisors that we think should be getting a top tier deal. And they come back with a second or third tier deal and we end up scratching our head, right? And so what do we do on those, right? And you and I know what we do, right? But for the advisors listening, what we're doing on those is we're working with the firms to understand why. We're working with the firms to help them get a top tier deal. And if not, and if it comes down to why that firm versus another, we will obviously have multiple firms in the fold. And as you said in the beginning, it's not always about economics, right? We have to look at why that firm, and that if the firm is coming in with subpar economics and their value proposition is mediocre, then it's a pivot, right? We 86 that firm and move on to someone else.
So Jeff, just talking about, what you were just mentioning. I mean, do you think we're at the peak of upfront economics, or to advisors, or do you expect them to potentially go higher? And we might have differing thoughts on this, which is okay.
Yeah, which is great because we haven't talked about it in a while. So the way I think about it is I think it's really going to come down to quality of advisor is really where I see that. I see that, and by the way, I see that also in the M&A space. I see buyers in the M&A space and the same thing in broker dealers, and this is where I think it's going to be. For high quality, someone that the advisor has a great business, I think recruiting deals or may even start looking at historical growth rates of the advisor. What are they bringing in net new assets, right? So it's not just the quality of the existing book of business, but if they're going to keep this advisor around for 10 years and they're overpaying, what have they brought in the last couple of years? Are they growing or are they flatlined? And so I think, and this is the same thing that has already been happening in the M&A space. I think what's going to be happening in recruiting deals is bigger deals are going to be able to be had, right? Some of it will come back to packaging of the advisor. Some will come back to, right? So how do you package the advisor? Quality team, similar characteristics that we look at in the M&A side, having junior advisors, having a planning approach, having fee-based assets under management, having a growth rate that's, above average. As we start thinking about recruiting deals, I think we're going to continue to see more aggressive recruiting deals for better quality advisor teams. And I think for the lesser ones, I think we actually may see some flatlining and potentially even some dropping off on that.
Yeah, I mean, I've noticed specifically, I haven't seen any deals coming down, but I have seen firms be a little bit more conservative in the way that they're structuring their deals, especially to financial advisors that are at more of a maybe a captive firm, or maybe historically bring less assets than an independent to independent move, which is almost always 100% of their assets transitioning from firm to firm. So a couple things that I've been seeing in some offer letters recently, some of these deals, 100%, maybe even 120% of trailing 12 production. But at the 6-month mark, if you don't bring 70% of your assets or 80% of your assets, some of that money is clawed back. That's something that is pretty unique that I haven't really seen in deals in a really, really long time. Or if a financial advisor signs an 8-year deal to move over to a firm, if they're $1 million producer and they don't hit $700,000 of trailing 12 revenue, basically their forgiveness doesn't start until they hit that threshold. So if it takes you 3 years to get back to that 700,000, that 8-year note potentially turns into an 11-year note. So I've seen some things on the back end for broker dealers from advisors at certain firms just to cover the huge amount of capital that they are deploying out there. So I have noticed that.
Yeah, I mean, again, when you skip, the more money you give, the more you got to protect that money that you're giving to make sure it's better quality. Like I said, I think that's going to continue to happen. I do think deals will continue to get more competitive. I think they're going to go higher. I'm seeing still individual deals hitting new records, and yet I still see other deals that are coming in at kind of medium levels, similar to what would be even a couple of years ago. So I think individually we're going to continue to see larger deals as the cost and the competition continues to increase. But firms are going to continue to look for ways to protect themselves so they're not writing bad deals, and they're going to be profitable in those. And so what you're talking about is really a way of protecting the firm, and we're going to continue to see more of that. Again, there's the great news for advisors is the opportunity is great. It's still going to be great. I don't see that changing in the near future, right? What's the near future? The next several years. We went through a period of time where interest rates went from a reasonable number down to 0, and we still saw huge deals. We've now gone from a period of time and the huge deals we saw then haven't dramatically changed to where they are now, where interest rates, where Fed funds are over 5%, right? So we're still seeing large deals, whether the firms are as profitable on cash or not. But it really comes down to making sure that they're writing on the individual scenario, that firm likes that scenario. The one thing I would say about that, which I think is really important, is each individual broker dealer that might be giving a deal, they're going to view what is a quality scenario differently. And so that's something that's really important, right? Of course, you and I deal with this every single day, but different firms value things differently when they're looking at deals, which is why sometimes when we're talking to 2 or 3 firms that are all very competitive on an average basis, one of the firms will be great, the other one might be medium, and the third one might not be good at all. And on a different advisor, they'll be flip-flopping in position, right? So it's not just the deal itself, it's the deal and the firm and that cross-section.
Yeah, I mean, I definitely think that's a place that we could help. Us seeing these deals every single day. Once again, economics not being the most important decision maker in the process, but us understanding your business, understanding the makeup, we understand where it's attractive and where it's not. So, holding all other things constant, we can help you maximize those economics. So one thing I wanted to cover on the call today is there are some firms out there where you just aligning with the right firm, economics can be significantly higher. So one huge change that I've been seeing in the industry over the last couple of years is firms moving from doing their underwriting on a trailing 12 revenue basis and giving you a percentage of that, and just giving a little bit more thought on the actual assets under management that you have. So for certain financial advisors, there's a real way to maximize the upfront money that they could potentially get out there. And I'll give an example. I have a financial advisor right now. He's doing $1 million in trailing 12 production. He has quite a bit of brokerage business. He has a low ROA. So he's doing $1 million of trailing 12 revenue, $180 million in total assets under management. And the firms that are still underwriting on trailing 12 revenue are coming in almost 50% lower than some of the firms that are off of assets under management. So we found a perfect firm for this advisor. off $1 million in trailing 12 revenue up front, this advisor is getting $1.8 million, which if you consider that in trailing 12 revenue, that's a 180% deal to make a move to the independent channel, which is almost unheard of. But we're seeing more and more every day advisors with more assets. It's just one specific area where we could help advisors find the right firm to maximize the economic impact for them.
I assume since you're saying he's independent, that scenario, he's also at a 90+% payout and all of that as well.
Full ownership and everything. Correct.
Yeah. Yeah. It's I can't help myself here, and you know where I'm going to go with this also, Corey, right? At Bridgemark, we talk about the, feel, fit, and financials. And when you're looking at firms, it's our belief and our experience that you really want to consider the firm feel, right? The culture of the firm, and make sure it's philosophically and culturally aligned with you, your business, and your business goals. And that really is the most important part of that decision. And then the fit is the business itself, and make sure that the technology and the tools and the products and the resources and the things that your clients are going to need really match. And then of course there's the financials. And while today we're talking all about financials, I can't help myself to make sure everyone recognizes financials is really important. It's 1/3 leg of that three-legged stool. But that three-legged stool has two other that equally or even more important legs with feel and fit. And so that's, when you're looking at firms and when we're helping you look at firms, we really are helping you through all three of those phases of that.
For sure. For sure. And Jeff, one other thing that I just wanted to mention, I think, some independent broker dealers maybe 2 years ago were all part of that arms race that we were talking about. But there were some really, really high quality firms out there that are just really known for customer service, really known for having awesome home office staff, constantly winning awards, that they didn't really play in that. They said, listen, if you want to make the move over to our firm, you're joining for the customer service. You're joining for the community. You're joining for things other than upfront money. And there's quite a few of those firms out there. I would tell you, I was having a conversation with an advisor the other day. He was looking at a larger independent firm and a smaller firm. And he wound up a couple years ago choosing the larger firm because it was about 60% of his trailing 12 revenue more to make the move over there. Wound up making a huge mistake. And I told this advisor, even those smaller firms now are starting to get really close in upfront economics. So it's not really making that decision of, top-notch customer service versus upfront economics. It's all really comparable now. So you could, really make a smart decision and still make it a profitable move for yourself.
Yeah, no question. I mean, it really is an arms race, and firms don't want to be left behind is really what's happening, and they understand that the economics are critical in that decision making. They also understand that not everybody's evaluating the full effect of feel, fit, and financials, right? And financials, when they're not working with Bridgemark, which we understand is a lot of people, there's a lot of people who overweight financials, and if they're not going to even be in the ballpark, then they're going to lose out. So it's forced them to reevaluate their offering to at least be competitive. They don't need to be top of the table. And in many cases, they don't even need to match, but they need to be close enough to make it so they can get to the final stages and win those advisors. And that ultimately is working to the advisor's benefits, right? Because it's giving them more choices with a more competitive economic comparative offering. And that's exactly what is better for advisors in general.
Yeah. And most of the time as well, if we get down to it and it's between a firm with a significantly higher upfront economics versus a firm that is just like a fantastic philosophical fit for them, most of the time we can negotiate with that firm as we know the needles that could be moved just doing this so many times to get you as close as possible to closing that gap. If not, most of the time closing the gap completely to help you make the true best decision for you and your clients.
Yeah, it's a great point. I mean, it's an interesting business that happens here. There is no public information on this, right? It's not like real estate where you have, transaction history and Zillow talking about the transactions of the recent prices, and you have comps on recent homes that have sold in your neighborhood. There is no public information on this, and we have effectively become that public information market for advisors because we're just doing so much work with so many advisors in a given year. So we really are helping advisors a lot in those negotiations. There's no question.
Yeah, I totally agree. Jeff, is there anything else that you want to add?
I think if there's one other thing I would add, I would say, watch out for headline numbers. I think that's the one last area that we're seeing a lot is there are headline numbers that are out there. And I'll even go back to one I used earlier, 400%. Is the headline number the real number? When the wirehouses, and goes back, certainly over 10 years ago, probably even 15 years ago, when they first went to 300% deals. And those first iterations of 300% deals, it was fewer than 10% of advisors that were actually achieving the growth goals to receive the full 300%. So while the headline number might have been 300%, in reality, advisors were only getting, 150 or 200% because of some of the goals that had to be achieved to get the full payouts. And so I think the biggest thing I would say is there is a headline number that's out there for everyone, and a lot of folks are putting out really high headline numbers. And then there can be iterations to that. Those could be considered clawback provisions. Those could be considered growth goals, right? There's a lot of other factors that can come into that number. Those could be just operating expenses, payout rates. And if the cost of doing business, once you get there, is a lot higher, then the headline number, you're just borrowing your own money, is effectively what you're doing. So really be careful and aware of, there's a headline number which sounds great and looks great, but there's a lot more economic, numbers inside of those deals that should also be considered.
Yeah, for sure. And the only other thing that I would add is, a lot of advisors, they'll reach out to me and they say, Corey, I'm not ready to make a move, but I am curious about this. I feel like I'm wasting your time. And that's 100% what we're here for. If you just have any questions at all in terms of what the outside world looks like or economics look like, you can have a broad stroke conversation with us to help understand what those things look like without you being on the radar at 7 different firms and you going at this by yourself. So if you have any questions, please feel free to reach out to either me or Jeff just to have a confidential conversation. And if it doesn't go anywhere after that, totally fine. But regardless of where you are in this process, we could add a ton of value just doing this all day, every day. So, Jeff, I really appreciate you hopping on the podcast today. And if you have any questions at all, please feel free to reach out to us. Hope you have a great day.
Well.